Hello, everyone, and welcome back to the Peterson Institute for International Economics. I have the privilege as the Institute's president to introduce and host a number of policymakers and thought leaders from around the world on this stage, but few command the respect, the attention, or the influence that our speaker today does. I am, of course, talking about Christine Lagarde, President of the European Central Bank. President Lagarde is going to be speaking today about a new global map, European resilience in a changing world. This is obviously a new topic, a critical topic. In the context of Russia's barbaric invasion of Ukraine, we've all had to rethink or at least re-examine our assumptions about trade and about globalization more broadly in a world riven by national security. The other day, we had Christine's former colleague, European Commissioner for the Economy, Paolo Gentiloni, here speaking about some of these issues and saying how Europe has to rethink the old German phrase, Wandel durch Handel, change through trade. And of course, as we discussed then, Washington and the US has had to rethink our assumptions about not just Russia, but China and other more autocratic powers about whether our economic relations are consistent with our values and with their development in the foreign affairs sphere, in the security sphere. So we are very grateful that Christine Lagarde has come to the Peterson Institute for International Economics today to take up in her leadership role these issues, these fundamental issues to Europe and the world's future, that while she is, of course, completely focused on her duties at the European Central Bank and as a member of the world's most important economic discussions, she is thinking of the big picture, and we at the Peterson Institute are very proud to be the forum for that. Just briefly, President Lagarde has been president of the European Central Bank since November of 2019. Just prior to that, she was the 11th managing director of the IMF from 2011 to 2019, of course, years covering the global financial crisis, the Euro crisis, and many other key events. Previously, she held various positions in the French government, including as Minister of the Economy and Finance of France from 2007 to 2011, and Minister of Trade of France from 2005 to 2007. From July to December 2008, she also chaired the ECOFIN Council, which brings together the economic and finance ministers of the European Union. She has, of course, a wealth of honors, but I know she wears proudly being an officier, the Legion of Honor in France, which she was named in April 2012. She graduated from law school at University of Paris X and famously had a law career, including in the US, and obtained a master's degree from Political Science Institute in Aix-en-Provence, excuse my pronunciation. A leader on women's issues, a leader on economic issues, a leader on human rights. It's my privilege to welcome Christine Lagarde. Thank you.
Thank you very much, Adam. Well, thank you so much for your kind words of introduction. And let me just assure you that it's a pleasure to be back at the Peterson Institute. It's a pleasure to be back in Washington altogether, but I have fond memories of previous good discussions and debate that we had in this very room. Throughout human history, economic relations and values have fundamentally shaped how we understand and interact with the world. And this point is well captured by the production of maps, including from the medieval times. These mappae mundi, as they were called, depicted worldviews informed by trade links and value systems. Well-trodden trade routes, obviously famously the Silk Road from ancient times, meant that Asia and North Africa routes from those days prominently figured in those maps. One of those mappae mundi, the famous Ebstorf map, often portrayed the holy city of Jerusalem as the center of the world. Today, rising geopolitical tensions are changing our global economy. Russia's unprovoked, unjustifiable, and atrocious aggression of Ukraine has triggered a fundamental reassessment of economic relations and dependencies in our globalized economy. And in a post-invasion world, it has become increasingly untenable to isolate trade from universal values such as respect for the international rule of law and human rights. And once more, fluctuating value systems and shifting alliances are creating, as we speak, a new global map of economic relations. The economic fallout from Russia's invasion of Ukraine may mark a redefining moment for globalization in the 21st century that will change, once more, our maps and our representation of the world. It is still too early to say how this will play out, but one can already see the emergence of three distinct shifts in global trade. From dependence to diversification, from efficiency to security, and from globalization to regionalization. And these shifts have implications for all of us, but certainly for Europe. And we must respond accordingly if we are to thrive in this new and increasingly uncertain global terrain. But that does not mean restricting trade. Rather, we must work towards making trade safer in these unpredictable times, leveraging on our collective and regional strength. Will it be easy? No. But as Christopher Columbus once said, you can never cross the ocean until you have the courage to lose sight of the shore. So let's just have a look at where we are currently with globalization. The years following the fall of the Berlin Wall marked a golden era for globalization. The drive for increased efficiency saw global value chains blossoming along the rising tide of trade. Production becoming increasingly unbundled across borders. Today, around half of global trade is related to global value chain, or GVC activities as it's called. Europe in particular benefited from the march of globalization. Trade as a share of GDP rose from 31% to 54% in a matter of the last 20 years. Whereas in the United States, it rose from just 23% to 26% over the same period of time. Europe's integration with global value chains was deeper too, with GVC participation roughly 20 percentage points higher than in the United States. The economic benefits of all this were real. Integration with global value chains led to lower import prices, technology spillovers, and productivity gains from the international division of labor. And when regions were faced mainly with local shocks, trade openness helped buffer the domestic effects, allowing countries to diversify risks and exploit multiple sources of external demand. So that worked quite well. But two factors emerged in recent years that expose the vulnerabilities of this model. First factor, the efficiency gains of this unfolding of production have been shown to be prone to risks. As global supply chains have become progressively leaner and more efficient through just-in-time production, they have also become incredibly vulnerable to disruptions in the face of not any shocks, but global shocks that affect multiple sectors, multiple countries at the same time. In fact, we saw that clearly during the pandemic, global value chains materially transmitted and amplified the global shock. It was no longer the hedge against local shock. It was an amplifying factor. During the contractionary phase of the pandemic, GVC-related spillovers amplified the decline in global imports and exports by 25%. And during the recovery phase, mismatches between burgeoning global demand and restrained supply have contributed to surging industrial goods inflation. Supply bottlenecks are found to have contributed to half of the rise in manufacturing producer price inflation in the euro area. So that's the first factor. Global shocks affecting multiple sectors and countries. The second shock. It has become clear now how much global production relies on critical raw materials, especially those sourced from a few countries. An arrangement that can quickly become a vulnerability when geopolitics change and countries with different strategic goals emerge as more risky trading partners. For instance, China was estimated to control over half of the global rare earths mining capacity in 2020 and 85% of rare earths refining. In Europe's case, the European Commission has found that 34 products used in the EU are extremely exposed to supply chain disruptions, given their low potential for diversification and substitution inside the Union. And this vulnerability has become more evident as a result of the Russia-Ukraine war. The euro area is highly dependent on Russia for, among other things, cobalt and vanadium. These are key inputs for the 3D printing, drone and robotics industries. And Ukraine accounts for around 1/5 of Europe's supply of wire harnesses for cars. The war has already forced wiring plants in the country to simply shut down, causing some car manufacturers in the EU to halt production altogether. The export-oriented agricultural sector has also been affected. Perhaps more importantly and better known, the war has exposed the vulnerability of Europe's energy supply. In 2020, the EU imported around 60% of its energy, a reliance that has actually increased since 2000, despite the growing share of renewable energy production. And just 4 countries inside Europe accounted for over 70% of the bloc's natural gas imports, with over 40% coming from Russia alone. So these two factors, global correlated shocks and dependencies, particularly on supplies with no substitutions, have underlined that the earlier advance of globalization largely relied on this Goldilocks scenario of relative economic and geopolitical stability. However, economies could be subject to huge volatility, as we have seen. So many countries are now faced with the question of how to respond to these new vulnerabilities. And the answer is not to withdraw behind our borders, not to erect trade barriers. History shows us that retreating from global trade comes with substantial costs. We all know of many studies, but one that I find quite striking is that of the United States' self-imposed embargo on international shipping back in 1808 that cost roughly 8% of gross national product. So what else? Instead of restricting trade, we should work towards making trade safer. And there are signs of 3 shifts that I'm going to discuss now. The first one that I call from dependence to diversification. Having learned the lesson of the pandemic, firms are unlikely to remain dependent on relatively linear global supply chains. But that does not, in the first instance, mean that they will seek to deglobalize and reshore production as we initially thought or feared in the early days after the pandemic started. Initially, we were more likely to see a greater focus on diversifying suppliers and stockpiling essential inputs. Research finds that higher diversification can almost halve a supply shock's negative impact on a country's GDP. And indeed, existing supply chains that were more geographically diversified helped to mitigate the effects of domestic shocks during the pandemic. By contrast, greater supply chain concentration is found to have increased economic volatility. This diversification trend is already underway. By the end of 2021, almost half of companies had diversified their supplier base, in contrast to just 5% that had implemented reshoring measures. At the same time, companies moved away from relying on just-in-time supply chain management towards the just-in-case approach. Less than 15% of companies were relying on just-in-time deliveries by the end of last year. But diversification is likely to have its limits. And this brings me to the second shift, which is from efficiency to security. In recent years, we have seen a shift towards new industrial policies, mainly led by China and the United States, in which geopolitical biases are being introduced into strategic supply chains at the expense of efficiency considerations. The US administration has explicitly identified friend shoring as a policy goal in its recent supply chain strategy. Now, the war might very well be a tipping point for Europe and other regions too, making the alliances to which suppliers' countries belong more important. International firms will still face strong incentive to organize production where costs are the lowest. But geopolitical imperatives might restrict the perimeter in which they can do so. For strategic industries such as semiconductors or pharmaceuticals, the very limited reshoring of supply chains we saw during the pandemic will probably change as a deliberate result of public policy. Europe, for example, is aiming to double its share of the global market for semiconductor production to 20% by 2030. But even industries that are not considered strategic are likely to anticipate the fracturing of the global trading order and adjust production themselves. A recent survey found that 46% of German companies receive significant inputs from China. Of those 46%, almost half are planning to reduce their dependency on China. In the United States, almost 40% of the members of the US-China Business Council have moved sourcing due to uncertainty about supply. And we should be watching the capital flows out of China in the weeks to come. For energy and critical raw materials, increasing security will require a different strategy. After all, these resources are distributed unevenly around the world and cannot be substituted with domestic alternatives. Regions will increasingly have to source their critical inputs from a smaller pool of potential suppliers that are deemed reliable. And all that in line with their strategic interest. And they will need to do so in the context of a green transition that is making certain raw materials like copper, cobalt, nickel increasingly more important than others. A new geopolitical race to secure access to resources is therefore very likely. Achieving greater security will not come without cost, and this is why the third shift from globalization to regionalization is also likely to gather pace. The price of increased security could in principle take the form of lower international risk sharing and higher transitional costs. In this changing geopolitical landscape, global export markets may not be as open or as reliable as before. Therefore, the scope for insuring against business cycle risks by rotating demand across multiple trade partners may become more restricted. This change could particularly affect Europe, given its high exposure to world trade. Between 2010 and 2014, when Europe was recovering from the global financial crisis, external demand as a share of euro area GDP more than doubled. But if other regions begin to turn inwards, that escape valve to relieve pressure from shocks is likely to weaken. In addition, the transitional cost related to a large-scale reorientation of supply will be significant. For example, establishing fully domestic semiconductor manufacturing supply chains within the United States is estimated to cost up to $1 trillion. That is more than twice the value of the global semiconductor market altogether. In addition, a rapid shift from lower cost to higher cost suppliers is likely to have implications for price dynamics, at least during the transition period. In this context, the first best option is still to defend the rules-based multilateral trading system that powered the rise of global trade. What is happening at the WTO at the moment and will continue to happen is to be watched and supported. But as a fallback, regionalization allows countries to recreate some of the benefits of globalization on a smaller scale and to limit these costs. Regionalization creates an opportunity for deeper regional risk sharing, both through trade and financial integration. This can, to some extent, substitute for lower risk sharing at the global level. It facilitates common funding of strategic priorities and investment in transitions, helping generate economies of scale. And it may also help to offset cost pressures emanating from higher energy prices and the associated elevated transportation costs. Regionalization is not a new phenomenon. In recent decades, it has gone hand in hand with faster globalization. But now, for the first time, we may see these two forces actually diverge. Fragmentation at the global level may ultimately spur greater integration at the regional level because the latter can help to manage the cost of a changing world better. So, how should Europe respond to these changes, and how is it positioned? I think that its main challenge today is to achieve what has been coined as the open strategic autonomy. What does that mean? It means striking a careful balance between ensuring against risk in areas where our vulnerabilities are excessive and avoiding plain protectionism. Having spent decades investing in regionalization, the EU is well placed to succeed in a world where the global order is more fragmented, while still acting as a force for trade openness. Let me mention, amongst many, 3 advantages that I see clearly for Europe in that respect. First of all, Europe has the world's largest single market, which gives member states a strong base in which to establish new supply chains, if strategic imperatives so require it. In fact, over 70% of the euro area's participation in global value chains was already regional in 2019. Second, we have long pursued a form of, I would call it, managed globalization within our single market. Although barriers to commerce and exchange have been steeply reduced, we have set up strong common institutions to police the market and ensure that countries have recourse to binding arbitration in the event of disputes. A governance is in place. This is likely to make openness more sustainable within Europe at a time when it could be under threat at the global level. Third, we have already made considerable headway towards pooling resources, which will be important in managing the ongoing transitions. The investment needs we face are massive, especially if we are to decouple quickly from Russia. But we have already set up innovative European instruments that can help, including the 750 billion euros, north of $800 billion, called Next Generation EU Fund, which was established in response to the pandemic as an investment force. Almost 40% of that spending has been allocated to the green transition across all member states of the European Union. At the same time, Europe has the potential to implement a positive sum form of regionalization that also makes the global economy more robust. The single market allows the EU to use its economic weight to steer openness in a rules-based direction and to set values and standards in other parts of the world as well, which it already does implicitly via the so-called Brussels effects. And because regions become more dynamic internally when they integrate further, we've seen that, we could see Europe emerging as another economic engine on which the global economy can rely to sustain growth. Recent decisions will help in this regard. Next Gen EU, this investment fund that I referred to, could increase real GDP in the EU by 1.5% by 2024. And were EU countries to raise military expenditure to the threshold of 2% of their GDP in response to the Russian threat and as encouraged by friends, this would imply an increase in government spending of 0.7% of GDP, which would add another 0.2% to euro area growth by 2024. But if Europe is to seize the moment, we cannot afford to stand still and rely on our past experience. New challenges may require us to design new instruments or repurpose old ones. And there are also existing integration projects that have somewhat stalled, that we talk much about but don't do much or not enough about, that are vital in this new environment. We are still lacking a complete single market for services, which will become an even greater hindrance to growth in a world where we telework. And European capital markets remain fragmented, segmented, limiting risk sharing via cross-border debt and equity holdings. Only around 20% of shocks in the euro area are mitigated in this way, compared with at least 60% in the United States. But I'm optimistic about Europe overall, in large part because the changing dynamics driving integration are likely to make the benefits of the EU more visible to its citizens. In recent decades, integration has been largely internally driven and triggered by economic crisis. There have been notable achievements, such as constructing the banking union, soon to be finished. But it is questionable how visible these successes are in people's everyday life. If you talk to them about the SME, the ESM, sorry, the European Stability Mechanism, very few Europeans know about it. Yet, it's an important element that was built and will help in times of crisis. So external threats are now becoming more prevalent again, regrettably. And this is driving integration in areas which arguably inspire stronger European feelings in EU citizens. For example, over 3/4 of Europeans are in favor of a common European Union defense and security policy. So one outcome of this changing global environment could well be to make the benefits of European integration more tangible and thereby increase the legitimacy of the EU overall. As you indicated, Adam, the Russia-Ukraine war has not only cast a shadow over Europe and caused horrible damage, suffering, and death, but it has also raised several questions as to where the global economy is heading in the 21st century. The shifts we are seeing may mean uncertain time ahead of us for trade. But being back in Washington, D.C., I'm reminded of the words of one of the founding fathers of the United States, who was also a true European, Benjamin Franklin, who once wrote, "No nation was ever ruined by trade." He didn't go as far as Montesquieu, but it was in the same vein. The benefits of globalization are indisputable. Open trade should not have to suffer in this global reordering. But that outcome is not guaranteed. It requires us to continue and to combine the pursuit of a rules-based international order with a drive to reduce our strategic vulnerabilities. And I believe, and I've tried to demonstrate to you today, that Europe is well placed to achieve this synthesis, guided by that compass of open strategic autonomy. Thank you very much.
Thank you, President Lagarde. Very powerful statement, please. There is so much for the people of Europe and the people of the world to assimilate from your remarks. I will try to modestly draw you out on a few things to.
Well, you're very knowledgeable about the topic as well yourself.
You're very kind. Let me pick up where you ended. Open strategic autonomy, which is a powerful phrase. And you also spoke about a phrase which members of the Biden administration have been using, friendshoring. I think it was first stated by Commerce Secretary Raimondo at the Institute's Next Step conference last fall, and obviously your colleague, Treasury Secretary Yellen, invoked it last week. Are these the same concept? To my ear, it sounds like you and whoever you're talking with on this topic have developed a bit more flesh on the bones than the Biden administration has offered so far on friendshoring. I'm obviously not asking you to evaluate what they're doing, but just, is the Biden administration or the US friendshoring approach compatible with an open strategic autonomy from Europe? Are they complementary? How should we think about that?
I think we should think about that together, because I'm not yet seeing a complete overlap, and I'm not certain that it is equally structured on both accounts, or sufficiently structured altogether anyway. So in terms of process, I think that it would require that authorities around the world who feel that they are on the same page in relation to the international rule of law, in relation to human rights, in relation to the basic principles, should talk to each other. And I'm not suggesting that it's a redefining moment a la Bretton Woods or a la Marrakesh for the WTO, but there has to be that dialogue, number one. Number two, I think it's not something that is only decided by public authorities. And there should be a dialogue between the private sector and the public sector represented by the various governments that are deciding to associate themselves for trade purposes. Because, as you mentioned, I've spent 20 years of my life in the private sector before joining the public service. And I think that it's really important that there is that dialogue, that public authorities appreciate the constraints, the investment cost, the write-offs, the imperatives that are driving the business and the investment decisions of the private sector. And I think that from those two dialogue between public authorities on the same page and the private sector with which they have relationships or over which they have authorities, that this dual dialogue actually frame a system within which trade will be safer, trading partners will be more reliable and accountable to each other, where there will be enough of a dispute resolution system and enforcement mechanisms that work. Because you could tell me, well, this is not totally different from what the WTO is. The problem that I see, having been Minister of Trade, as you mentioned, and talking to my esteemed colleague, Ngozi, who is the head of the WTO, is that there are some governance features in the WTO that impair or at least constrain its efficient functioning. Membership is one, right. Implementation of certain decisions, change of some of the rules, all of that is difficult. So, friendshoring, open strategic autonomy, I'm sure that they are, we are sort of traveling towards the same destination, but it needs to be fueled by this double dialogue and a system of governance that will be informed by what we are going through now and the constraints that are preventing us from having an efficient system at the moment.
There are so many things there. Let's start, and thank you, obviously, for being so responsive to my question, but let's pick up on what you were saying about the WTO and our mutual friend Ngozi, who has sat in that very chair a few months ago and talked about these things. As you're clearly aware, and I think our audience is, even as leader of the WTO a few weeks ago, I believe it was, she spoke about the opportunities for some emerging markets and developing countries through this regionalization. She made explicit reference to this, which I think was very realistic and constructive, but a bit surprising from the WTO head. Yeah. So just putting on, as it were, a bit of your previous hat at the IMF or as a participant in multilateral organizations, where do the prospects for emerging markets and developing economies fit into this world that we're talking about? Because I could see worries that if one has the luck of being next to Europe or next to the US, that, there may be no getting around it. That's nice. It's like you were born tall, that's just how it is. But should we worry that in a world of this kind of division, there's going to be bidding wars between, say, a Chinese bloc and an American bloc or a European bloc over loyalty? There's going to be neglect of countries that are not friend-shored or regional. I mean, you didn't really talk a lot about the developing world in this. How does this fit in?
We all speak from where we sit, right. And at the moment I sit at the heart of Europe, and I'm focused on making sure that the euro area in particular is right. Strong, that we have price stability, that the economy can develop, and that investments can be properly financed with financial stability associated. That's my brief at the moment, so I speak from that venture point. But I also speak from the perspective of how I have seen over the years 27 member states, used to be 28, but anyway, let's forget about them. Yeah. How 27 member states with a different history, different background, different political regime have eventually moved towards each other, have converged, and we do have that regular convergence report to check that things are heading in the right direction. are actually creating that platform where, while not agreeing on everything, they agree on sufficient basic principles so that they can trade with each other, they can freely move goods, capital, and people. And I think that that set of rules, principles, and that governance platform that has been built over the last 70 years has been really looked at by other regions. And when I look at what has been achieved by the African Union in particular in relation to trade, and the African Trade Agreement that was approved now a couple of years ago, you can see that this is also moving in that direction. And there is a lot that can be leveraged within a region, which builds a scale, identifies, cost benefits, comparative advantages of various members. And that gives added strength to be able to negotiate probably more on a par with other groups, such as the European Union. Mm-hmm. I have seen similar developments in the Middle East, where you have a number of countries that are not, I'm not sure that they are there or not, that they want to have a monetary union, but right. they are looking at it with interest, and while having their differences, and sometimes very strenuous one that brings them to shut roads and
all kinds
lines,
of nasty
all
things.
kinds of things. It's still moving in that direction. I really believe in the power of scale, supported by a governance platform that can bring together more of what they have in common rather than what divides them. Am I saying that it's easy? No.
No.
It's a laborious process. It's one that takes time, but that really brings benefits at the end of the day. Is that compatible with a global order? Yes, I would think so.
Thank you. As you said, of course, you are speaking from your current role and your current place as president of the European Central Bank. The European Central Bank has a particular mandate. I was a bit struck in your remarks. You were very focused on trade. Mm-hmm. You didn't talk very much about financial flows or currencies or things like that.
It was my beautiful intermission.
Yes, no. I'm glad to have it. We would love to be the forum for people like you to take a vacation and think deeply about globalization. That's great. It was not a criticism, but it does lead to the next question. In my own writing on related topics, and many other people writing at the moment, there's a lot of hubbub about the role of the dollar, how much the financial sanctions change the world, and it's many parallel questions to what you talked about in trade, in terms about values and security versus diversification and efficiency. I've been worried for some time that increasing divisions could lead to fundamentally less diversification of savings, and that has differing matters. Doesn't matter what I say. I'm just trying to buy you time. How does your argument go with financial globalization? How does the recent events and the sanctions go with the role of the dollar, the role of the euro? And in particular, one thing which colleagues here who you know well, Olivier Blanchard, Jeremy Zettelmeyer, who also worked for you at the fund, John Pisani-Ferry, we've talked a lot about how you spoke about the next generation EU funds, greater issuance of safe assets by the euro area as the euro area could be beneficial for the world. Mm-hmm. So could you say a bit more about how the monetary side of things goes with your globalization trip today?
I'll give you two examples, because I think that giving 4 instances sometimes speak louder than great rhetoric. You mentioned the sanctions that were decided against Russia. And those sanctions had, in addition to the technology side of it, had a very strong financial aspect to them. And we were all determined to identify the risk of Russia and Russian sanctioned persons, how they could circumvent the sanctions and move money around, and eventually have access to currencies that we wanted to deny them access to. Obviously, the use of crypto assets
Right.
was a possibility and could be a bridge and could be a way to circumvent. And I'll bring back my global platform and framework into the picture. We don't have a regulatory framework at the moment.
Right.
I said that 2 years ago. People mocked me a little bit at the time. And I continue to push, and I will continue to push, because I believe that this is an area which is related to our financial stability, which is related and could possibly cause concerns with monetary sovereignty. But we are with an area that needs to be regulated, where consumers' interests have to be protected, where transparency has to be in the cards, and where the risk of circumventing sanction, of breaching the rules of anti-money laundering
Right.
and countering the financing of terrorism have to be respected. Well, now I'm really pleased to see that there is a strong dialogue between all authorities. The Financial Stability Board, under the leadership of Klaus Nott, is also focusing on this. And you know, it's in a way, all of that is related.
Yeah.
The global order has a huge financial dimension about it, which you can tackle from that angle. Now, second example, we discussed the next generation EU $800 billion fund that is this sort of joint investment fund decided by the Europeans together, borrowed on the markets together, reimbursed together. This is clearly also an indication of a joint endeavor and a determination to, in solidum, create a greener Europe, a more digital Europe, and one that actually has a seat at the table of the great issuers. Right. It is not treasury bonds yet, let's face it. It's not deep enough, it's not liquid enough, it's beginning, but it's heading in that direction as well. So this global order will continue to have the dollar as a key international currency. The dollar is the international currency of reference, and it is fueled by these very deep treasury bonds markets. But we are seeing, and probably as a result of what we have lived through in the last 2 years, the emergence of a stronger financial Europe together.
Right. And just to reinforce that point, because that's part of why I share your optimism about Europe. From an open strategic autonomy point of view, can we hope that part of that agenda would be Europe actively trying to deepen its bond market for Eurobonds, its role in the global currency?
I certainly hope so. I certainly hope so, and I will work hard on that. I've been a great supporter and pusher for the capital market union in Europe. I think it's critically important, particularly at the time when we issue European bonds, and the Commission is going to be active on the markets, that we have that less fragmented, less segmented capital market union, and that we make it simple and attractive to investors to actually come and invest.
Thank you. So let me wake the sleeping panda, as it were.
I know who you're going to talk about, okay?
It has to be done. In the US, increasingly, a lot of strategic reevaluation and calls for autonomy and calls for friendshoring are framed particularly in terms of the strategic competition and the perceived threat from China. Europe has clearly aligned with the US on some of these issues, and on some specific things like internet privacy or certain kinds of human rights issues, they've been more aggressive than the US. But for the most part, Europe as a whole has been less confrontational with China. And again, I'm trying not to put a value judgment on one way or the other. I'm just trying to ask a genuine question. If Europe pursues your vision of open strategic autonomy, does that mean greater alignment with the US in terms of confronting China because of the values differences, because of security differences? Or does this mean greater balancing that Europe as a completely peer third economic actor sort of countervails if the US goes too far, if China goes too far. I mean, I'm putting this very abstractly. You can do for instances instead, but how does your vision affect the view of Europe's role between US and China and directly with China?
Well, clearly the expectations, the hope, and the optimism that we share is that Europe will strengthen, will deepen its integration, will become such a solid and scalable markets that it plays on a par with those large economic powers, the United States and China. And if actually the European countries were effectively together and accounted as one single country, it would be the largest. So that's the sort of preamble to what I'm going to say. But it matters because being on a par, let's keep it simple for the purpose of this discussion. If you're on a par, you have to know who your friends are. Right. And I think that knowing who your friends are depends on that governance that I was referring to and the respect for that governance and the mechanisms to enforce the rules of the governance, which is far from perfect and what it should be at the moment. But I think that, going forward, Europe as strengthened, as deepened, and as a strong partner on the global economic scene will be looking at diversification of supply, will be looking intensely at security of supply, and will be revisiting the organizing of trade relationship. And I think that it is reasonably well positioned to do so because there is a tradition in Europe, which has often been criticized, of involvement of the state, of active role in the definition of industrial policy. Right. It was very French to begin with, but I think that well, it's not just very French. I think it's a post-Second World War development that was caused by the massive destruction that had afflicted Europe and which caused all authorities to respond by rebuilding with the help of our friends, the United States at the time. But I think that culture has remained and will probably be helpful in order to direct industrial policy, in order to mix public and private investment for the purpose of leveraging those strengths, identifying friends, diversifying sources of supply, and making sure that security is as a focus of those policies.
I want to come back in a moment. You quite reasonably, and it, as you noted, consistent with your background, but also consistent with being transatlantic, talked about the private sector role as well, and I want to come back to that. But another issue that arises when you talk about industrial policy and setting priorities is, of course, the green revolution, or we hope the green revolution. Obviously, your counterparts in central banks and finance ministries around Europe, around the world, are making tough choices about, given the current energy shock, how much do you, to use a bad expression, lean in and use this as the opportunity to shift supply and raise prices, put a floor under carbon, versus lean against and cushion the blow. Obviously, any comments you have on that short-term issue would be of great interest, but again, taking it back to your vision of open strategic autonomy, how are the various nationalisms or regionalisms going to align with desire to have a global higher price for carbon, have global progress on green, in particular involving Russia, involving China, involving India? How do you see that working out?
Everyone should do what it can under its mandate. I preface my comments with that. And central banks are they're not driving the bus of the fight against climate change. They have to be on the bus. They have to see how climate change impacts their strategy, their instruments, their policies, and how their policies are informed by climate change issues. And we clearly take that on board, and that has been approved by our strategy review. Climate change is a very important factor in what we study, how we inform decisions, how we frame our tools and our investment policies. And we try to work in synchronization with the European Commission, which is soon going to come up with enough taxonomy request for disclosure and transparency on the part of the corporates whenever we are concerned by the value of corporates, notably through collaterals. But having said that, I think that there is a clear response to what you just said. It does not belong to the central bank world. It belongs to the fiscal authorities world, to the parliament world, and it's called tax border adjustment.
Right.
You know, I've always said in previous life that setting a price for carbon through whatever devices, you know, emission trading system, market-based instruments, or pure taxation are devices that can be used for that. But clearly a tax border adjustment is the way to go.
Another topic we want to go way back to, and but we're coming close to time. You've been so generous, President Lagarde, with your frankness, with your answers, and most of all your speech and your insights. But let me conclude with what you were raising about, or conclude with a question to you about what you were raising about the private sector. So, as you mentioned, it's French, it's European, it's also Japanese and Korean, but it's very unfashionable in a lot of places to talk about industrial policy. And it's very fashionable in certain places in Washington right now. We at Peterson have done a bunch of work on industrial policy through the years. Our colleagues, Gary Huffbauer and Meg Hogan, just did some recent evaluations. Our colleague Marcus Noland worked on the Japanese-Korean examples. Okay. What do you want to see in terms of private sector input to these industrial policies? What do you want to see as rules of the road to keep national champions, local incumbents from exploiting these industrial policies? And I guess finally, in terms of the private sector, you mentioned multinational companies, international companies sourcing. Do we want a world where companies are sort of forced to choose sides, or should companies headquartered wherever be able to sell into all markets?
On that latter point, Adam, I think that what we have seen developing in Russian cities at the moment is a clear indication that, if not the internal moral compass, at least the pressure of public opinion is sufficient to actually drive those decisions, irrespective of the profit and the cost base. What should we expect in the context of an industrial policy from the private sector? A lot. Because you mentioned it, you know, the greening of our societies and our economies is going to require so much financing, so much funding, that it would be ludicrous to expect that public money will suffice. It won't. So it's the reason why I started my first response to you with this dual dialogue of friends, public sector, private sector together to identify that platform and how we can move forward.
Thank you. Again, we thank to our entire global audience. I hope you will pass on the text, the video of President Lagarde's remarks today and discussion. This may turn out to be a historic speech. It is certainly an important speech and discussion because, as Christine said at our opening, we've had to reconsider the map and the worldview of the globalization we have, and she's offered one set of directions for how to navigate that new map, speaking of open strategic autonomy and of Europe's potential role in that, turning its vulnerabilities into strengths and building on its strengths. For that, I thank you. Please join me virtually in your appreciation for Christine Lagarde, President of the European Central Bank.
Thank you, Adam.
Thank you. Had to roll with